Thanks for joining us here on the Savvy Investor YouTube page. Now you can actually see Mike Canet, see the passion in his voice and his face as he helps you, grow, keep, and distribute your wealth in the most tax-efficient manner possible. The YouTube page is a little bit more topic focused, which we're going to get to here in just a minute. But Mike, you were just in Sturgis, and you got a story to tell us because it involves YouTube.
Yeah, it was pretty incredible. Sturgis, for people that don't understand it, you go to South Dakota, the Badlands, Mount Rushmore, Crazy Horse.
Awesome.
And in general, there's maybe 100,000 people that live over this, 50 to 100 mile radius that we stay in. And during Sturgis, a bike rally week, it gets up to 500,000, 600,000, 700,000 people come in for this rally. Mm-hmm. So one night I'm staying with a bunch of friends. We have a house, and I go to pick up some wine for dinner, and I'm standing in the liquor store waiting my turn. And this guy next to me looks at me and goes, "I know you." And I said, "You know me? I'm in Rapid City, South Dakota. I'm not on the radio here. I don't do advertising here. How do you know me?" And he said, I've listened to your podcast, and I've seen your YouTube channel. I've watched stuff on YouTube." And his name was Dylan. And it was just amazing because out of the blue, this guy recognized me. So yes, we are nationwide on our podcast. We're nationwide advisors, and we are nationwide on our YouTube channel. And I was just really impressed that he recognized me, because, you don't always know who actually watches these things. So it was just a really neat experience to be a celebrity, my 15 minutes of fame,
And that's got to be a great feeling, too, because you're able to help people wherever they are.
Absolutely.
In the nation.
Absolutely. Now, I was a little disappointed. He didn't ask me for my autograph, and he didn't take a picture with me. So I was had my hopes up there for a minute. But in general, it was a very cool experience. We had a nice little conversation. He pays attention to taxes. He's a businessman, and he's always looking for tax advantages. So he always listens in to hear about the tax planning that we're doing. And that's what drove him to the channel in the first place. That's why he pays attention to the podcast and the YouTube thing. So it was just a really cool experience.
Well, we are going to talk about taxes in this episode.
Surprise.
And if you're Dylan or want to be like Dylan and want to meet Mike Canet, even if you want to get his autograph and get some great tax and retirement advice, just click on the link in the description below to schedule a complimentary personalized review with ProStatus Mike and the team.
If you click on that link below and you ask for our book, you actually get my signature, because I do sign all the books.
Hang on a second. I'll get that.
Yeah, there you go. Oh, you have a copy?
I always have one.
Yes,
at arm's length.
That one.
And that is, by the way, it's nothing is certain but death and taxes until now. I kind of messed that up. Let me do that again. It just wasn't a good announcer voice. Nothing is certain but death and taxes until now. And that is a book from Mike Canet. So if you're watching that, you can click down there and they'll get you one, and they'll autograph that. Okay. So let's get to the topic at hand, and that is taxes and some changes to retirement savings rules to know before year's end this year, 2024, going into 2025. You guys keep up to date with all of these changes at ProStatus and have a list for us here. The first one is no more RMDs from Roth 401k plans. This has got to be a good thing, because if my money's in a Roth, I'm not required minimum distributions, RMDs, to take that money out if I have got a Roth account.
Right, because you've already paid tax on the money, and the money's coming out tax-free, so there's really no incentive for the government to force you to take it out, unlike the traditional 401k, traditional IRA, where they want their tax dollars because they encourage you to save that money. You never pay tax on it. Now that it's gone from the little apple seed to this big tree producing apples, they want tax on each apple. So yeah, it's nice to see them. They made it consistent with the personal Roth 401k, the traditional Roth IRA and the Roth 401k are now congruent with each other. You don't have to do RMDs. Now, of course, when you leave the money to your children, whoever your beneficiaries are, they're forced to take money out. But you, fortunately, are not forced to take it out. And I do want to, I know we're talking about it from a tax perspective and RMDs, but I do want to share a story. I saw this just recently, and I was kind of shocked that the advisor had recommended this. This guy was he was still working, and he was 80 years old, and the advisor had told him to roll his 401k into an IRA. And the guy had done it on the advice of the advisor. And now this guy was having $300,000 RMD requirements every year because it was in his IRA.
Wow.
And the guy was like, but I don't need the money. I'm still working. I love what I do. I don't ever want to retire, but I'm being forced to pay tax on this money. This is insane. And I explained to him that, well, your solution really is to roll the money back to your 401k, because if you're still employed and you're still otherwise eligible to contribute to your 401k, there are no RMD requirements from a 401k, Roth or otherwise, like there would be from a traditional IRA. So yes, understanding that they've waived the RMD requirements for the Roth 401k is important. That's a great rule. But also working with somebody who truly understands the tax implications of IRAs and 401ks and those RMDs that are so horrible for everybody, because half of my clients, half of the people that we work with don't actually need the money in those accounts. And yet they're being forced to lose 20, 30, 40% right off the top to taxes because nobody gave them the right advice. And if you want that right advice, if you want to figure out how to maximize the benefit of some of those accounts, just click on the link below and set up a time for us. It just says, just click there. Go to our calendar, set up a time. It's a 15-minute conversation, and we can talk about your tax situation. We can talk about how to take advantage of those 401ks and IRAs to put you in the lowest tax bracket possible. Literally, just go to the bottom of the page and click.
And don't forget to like and subscribe to our YouTube channel as well. That hopefully you're enjoying watching us right now. Next one here, as we talk about changes in retirement savings rules to know before years, and the government. Yeah, the government tells you, hey, you got to take this money out. And if you don't, guess what? We're going to nail you for 50%. That's also changed, thank God. Starting in 2023, the penalty for missed required minimum distributions, RMDs, was reduced to 25%.
And if you fix it,
what it was before, it was 50%. That's right. So they're giving us a 25% break, but that's still a lot if you miss it.
Well, and the fact is that in the old days, right, before they changed this rule, and it was obviously 50% is draconian, and it's a 50% penalty plus the taxes,
plus
right?
The taxes that you have to pay.
If you were supposed to take out $2,000 and you're in the 25% tax bracket, you lost $1,000 to penalty and you lost another $500 to taxes. So it was a very draconian rule. But the reality is that, I don't know, I've been doing taxes since the early 80s, and I'm going to say probably 100 or more people have come to me over the years and said, hey, mom and dad, and it's typically the kids come into us, mom and dad didn't do an RMD. What do we need to do? We need to fix it. Or a spouse comes to us because she or he's been taking care of their sick spouse and trying to figure out these RMD things. But before this, if you missed an RMD, if you made a mistake on RMD, we as the tax professionals could fix it. We do the distribution and we send in a little form to the IRS saying, hey, please forgive us. The dog ate our homework. We got hit by a tornado. The house burned down.
Got hit by a pickle truck.
Hit by a pickle truck. And in all the years I've done this, the hundreds that I've asked for forgiveness and a waiver of the penalty, not once has the IRS said no. Every single time the IRS has said, we're going to waive the penalty. Now, you can't ask for it year after year after year. You can't forget. But most of the time, somebody comes to us and they haven't done it for 2 or 3 years, and we fix it all at once, say, sorry, again, the dog ate my homework, or the advisor didn't do it, or whatever it happens to be. And the IRS has always waived it. Well, now that they lowered it to 25%, I'm not so sure they're going to waive it anymore. I mean, I know there's the rule has a little caveat on there that says if you fix it within a certain time period and you pay it immediately, the penalty is reduced to only 10%. But in general, I think they're looking for that 25% for additional revenue because they want to spend your money and they think they're better stewards of your money. They think they spend your money better than you do. And if you want to understand how taxes work, if you want to try to save on these RMD issues and not be penalized, and more importantly, maybe how to avoid having to do RMDs in the first place, just click on the link before, sit down with Ryan, myself, and our team, and we're going to take 15 minutes, talk about what we can do together, make sure it's the right fit. And if it is, we'll set up some follow-up time to actually do some analysis for you to try to get you into that lowest tax bracket. Click on the link before, and don't forget to subscribe to our YouTube channel and like us there as well.
All right, one more here regarding the changes to retirement savings rules to know before years, and that is 401k catch-up contributions for high earners must go into Roth accounts. Why the change here?
Well, so people that make,
of course,
too much,
in your opinion.
Yeah, right. But so people that make too much money, and I'm doing those air quotes, right? Too much money, whatever that actually means. The IRS doesn't want to give you the ability to put more money away into a tax-free account. Now, they they said you can't put it into the Roth 401k, but there are other tax-free accounts that you can put it into that will grow just as reasonable as a 401k might grow for you. But they want their money up front. That's the IRS saying, we don't want to give you the opportunity to have more tax-free money for yourself. We don't want to give you the opportunity to pass more tax-free money on to your heirs. We want the money now because, well, we're good stewards with your money and we think we can spend it better. Again, another insane proposition from them. I don't agree with them. I don't like the idea that just because you make more than $145,000, you can't put money into a Roth. You can't do your catch-up provisions into a Roth. Certainly, it makes sense to allow them to continue to do that. And if you're stuck in that position and you're looking for alternative solutions, absolutely click on the link below because we have alternative solutions. Just because the government doesn't want you to be tax savvy doesn't mean you can't be tax savvy with us. Click on the link below and don't forget to subscribe and like our YouTube channel as well.
I can tell your blood starts to boil every time you
drive me crazy. Drive me crazy.
Government and taxes and how well they spend our money, right?
Yes. We don't need tax breaks. Believe it or not, we don't need tax breaks. We need people that actually do tax planning, because if you do your tax planning correctly, we don't have to listen to those politicians saying, we'll give you a tax break, because we can show you the rules are already there so that you can be in the 0% tax bracket if you choose. And I know people go nuts and people get upset when I say paying taxes are optional. I'm not saying you can choose whether you want to pay taxes or not. I'm saying you can choose on how to arrange your financial affairs to be in the lowest tax bracket possible. And the lowest tax bracket possible is 0. And if you click that link below, we can get you started towards a 0% tax bracket.
And also get you this book. Nothing is certain but death and taxes until now.
So with my signature in there
as well. Oh, so that's right. You're going to give him the signature. Again, click the link below to schedule a complimentary personalized review with Mike, with Ryan, with Catherine, with Lawrence, and the entire team at Pro Status. And don't forget to subscribe to the YouTube channel, which you're watching right now and hopefully liking as well. So, Mike, got to wrap things up. Thank you guys again for watching. As always, we try to give you the best information to keep you up to date. Mike, you get the final word.
Look forward to seeing you next time. Thank you for joining us on the Savvy Investor YouTube channel. This is Mike Canet. We'll see you, the Savvy Investor, next week.